Let's take situation when the goods are out of the firm but not for sales. For example, goods taken by the proprietor as drawings. It means the owner or proprietor is going to take the goods out of the firm for his or her personal use, and they are called drawings. Or another situation can be goods lost or damaged by fire or by accident or by theft. Means if in this situation the goods are out, means we have lost the goods, whatever the reason, whether it was theft or whether it was fire or some accident, but the goods are out. And let's take one more situation. Goods given as charity. For example, you are running a bookshop and you give some books to some school to be distributed among poor students. So the goods are out of the firm for charity. And goods given as samples. Sometimes some companies or some firms, they distribute the goods among the customers free of cost as samples so that they can introduce the product in the market. So it means this is the case of advertisement. So there are so many other situations where the goods are out, but you cannot call them as sales. So whenever the goods are out, if we go to the table of options, if the goods are out, we place it on credit side. Under the situation, credit what goes out. If the goods go out, that will be placed on credit side. So on credit side, you will write down goods. But goods are never mentioned either on debit side or on credit side. They are mentioned as purchases account or sales account. In this situation, means if the goods are out for drawings or for loss or for charity or samples or advertisement, always credit purchases account. So you cannot write down to goods account, you will have to write down to purchases account. I will explain you later why we are going to credit purchases account when I start the chapter exclusively on journal entries. At present, I am trying to explain you the accounting cycle through journal entries. Now let's take one more practical question, and this time I'm going to change the style of the question. The question is, balances as on 1st April 2012, cash 6,700, stock 100, purchased goods rupees 1,000, sold goods costing rupees 800 for rupees 3,000, cash lost by theft rupees 500, goods lost by fire rupees 200, closing stock as on 31st March 2013 rupees 100. So one thing is clear from this question, nobody is going to start business in this situation. It's a going on business because the balances on 1st April 2012 were capital, cash, stock, etc. Everything is given. So it's an old business. Maybe the owner has been running this business for last 1 year or maybe for last 10 years. So we are not concerned with that. If you have to make the journal entries of the running business, So first of all, make the balance sheet, opening balance sheet. So what will you write down? Cash on the asset side 6,700, stock 100. There is no other asset. It means the total of the asset is 6,800. On liability side, nothing is given. So no need to say it must be capital, because without capital, there cannot be any business. So capital 6,800 rupees. So balance sheet is given. This is the balance sheet as on 1st April 2012. And this was the closing balance sheet as on 31st March 2012. Because the closing balance sheet becomes the opening balance sheet for the next day. It's not a basically balance sheet. Just for our convenience, we have made the opening balance sheet. So first of all, you will have to draw opening journal entries. You know how to make opening journal entries? Debit all assets and credit all liabilities and capital. So the opening journal entry will be cash account debit 6,700, stock debit 100, to capital account 6,800. And the narration will be being opening balances of all assets and liabilities. Now start drawing journal entries. Purchase goods. So that will be purchases account debit to cash account rupees 1,000. Then the transaction for sales, and the journal entry will be cash account debit to sales account rupees 3,000. Now the transaction is cash lost by theft rupees 500. It means somebody has stolen cash from our cash box and the amount was rupees 500. So come to the options. On debit side, debit all expenses and losses. Is there any expense or loss? Yes, there is a loss of rupees 500. So write down loss by theft. Now come on credit side. Credit all incomes and gains. No. Credit what goes out. Has anything gone out? Yes, cash has gone out. So you write down cash. So use the suffix of account, loss by theft account, and then to cash account. So what will be the journal entry? Loss by theft account debit rupees 500 to cash account rupees 500. Now move to the next transaction. Goods lost by fire. And it was rupees 200. So we are going to assume that the cost of the goods was rupees 200, not the selling price. Because if the goods are out, not for sales, we always need cost price, not selling price. So on debit side, debit all expenses and losses. Yes, there's a loss because our goods have been lost by fire. So you write down loss by fire. Now on credit side, credit all incomes and gains. No. Credit what goes out? Yes. We have lost the goods. Goods have gone out. So you write down goods. So on debit side, loss by fire account, and on credit side, goods account. I am to say two goods account. No, we cannot write down goods. We will have to replace this word either by sales or by purchases. You know this is not the case of sales. So we'll write down purchases account. You might be thinking, we have not purchased goods. Why we are using the word purchases? I have already explained you. At this moment, I'm not able to explain you why we are going to use purchases account. I will explain you in the upcoming segments. So you know, whenever the goods are out, whatever the reason, but it's not sales, you have to write down purchases. So loss by fire account debit 200 to purchases account rupees 200. So this will be the journal entry and the narration will be goods lost by fire. And at the footnotes, closing stock as on 31st March 2013 rupees 100.